I want to go into how most of us live a life of default first, and this is essentially why you're broke. That answers your question. For most people, the majority of America, middle class, however way you want to put it, if you're working for the man, which I am actually right now, but I also do a lot of ventures on the side. But if you're living a life of default, what you find out is that a third of your income goes straight into taxes. A third of your income goes into interest that gets paid to the banks, leaving only a third for your lifestyle. And that life includes your rent, your food, your transportation, all of those typical expenses. What I want to show you is how you can design your life such that we minimize interest and we minimize taxes, and leaving more for you to keep in your own wallet for your lifestyle. But first, I want to show you this quote from one of my mentors. His name is Jim Rohn, and he says, "If you will change, everything will change for you." So it's like, man, I'm stuck working 2 jobs, barely making ends meet, living paycheck to paycheck. How do I change it? Well, Jim Rohn would say, if you change your mindset, everything changes for you. So aside from, societal problems where, people have lack of income or otherwise lack of opportunity, a lot of people are just making a lot of money or even decent money, and yet they're still broke. So I would call those people broke at a higher level. And why is that? So what do these 6 people have in common? You'll probably recognize them as some of the world's most famous billionaires. But another thing that they have in common is that each of these people did not inherit their wealth. They generated it, they created something that was of value to the market, and that is how they became billionaires. They weren't born into wealth necessarily. See, the employee mindset, with the mindset of an employee, there's only 2 currencies: time and money. And if I asked you what's more important, you'll probably say time is more important. But most people go on living as if money is more important, when in reality, there's actually 5 currencies, and that's time, knowledge, relationships, credit, and money. And you don't need all of these in order to become a business owner, a real estate investor, or otherwise create that life of design. You only need 2 or 3 of them. And most importantly, your mindset. So if you open up your mind and allow some of these to come to you, or go out and seek some of these, the rest comes, even though, for example, I may only have time and knowledge and relationships, but I can leverage those to partner up with somebody and do deals when they bring their credit and someone else brings their cash, and partnerships form. So there's a lot of opportunity when you provide something, one of these 5 currencies of value, and you don't need all of them in order to be successful in life. And now you'll notice these are actually in order of priority. And you'll notice that money is at the very end because it's the least important, actually, and you'll see that. We'll need a lot of time. Time is the most important. Time is the most valuable resource. It's the most non-renewable resource. We can never get our time back. You'll need knowledge. Knowledge is something that once you have it, you can never be taken away from you. And relationships really catapults you to a new level and really just speeds everything up. It's like a catalyst. It just makes you go way faster. You can do things on your own, but when you do it with friends, it becomes way more fun too, right? And then, of course, credit and money. Now, they may be the same. Some people would say credit and money are different. Some people would say relationships and credit are kind of the same too. So you could narrow this down to maybe 4, depending on how you see credit. Now, I see credit with the banks different from how I see credit with my partners and my friends and family and others who might be willing to do deals with me, given that I have time and knowledge. So credit with the banks is like your FICO score. And actually, on a side note of that, did you know that you don't have a credit score? Specific lenders pull data from specific bureaus and run it through specific algorithms, depending on the type of product that you're trying to get with them, in order to generate a score for that product. And credit scores don't get you approved, they get you denied, or they get you moved on to the next level. Underwriting, that is. But anyway, the way the credit system works is basically a game. It's like a game of chess, and yet everyone's playing checkers. So you got this game that they've set up over the past several decades, and everyone's playing it by default, as soon as they turn 18 at least. Even before they turn 18, they're playing it sometimes. For example, I gave my brother an authorized user account, or I added him as an authorized user on one of my credit cards, and the moment he turned 18, the credit bureaus had profile on him, and immediately he had a 750 FICO. So there's ways to go around that. But also credit can also be used as in place of cash, and we'll see that today. So the employee starts to think, okay, how about we just work for 40 hours a week for 40 years, only to retire and make 40% of the income that they're used to. That's the 40-40-40 rule. That is supposedly the American dream. And they think that they have to save up and grow this nest egg in order to retire somewhat comfortably, right? That's assuming Social Security is still around, assuming other benefits are still around. Well, a wealthy mindset says, why collect a nest egg and accumulate all that over a long period of time when you can simply, whoops, my goose, buy the goose or chicken, buy the chicken that lays the golden eggs, and the egg kind of disappeared. Come back. There it is. It went away. Oh, well, I messed up the animation there. So the wealthy think, why not just buy a chicken that lays eggs for you? If you haven't seen this diagram before, this is an idea that I learned from Robert Kiyosaki in his book called Cashflow Quadrant. And what it shows is, come back, there are 4 ways that people generate income. On the left-hand side here, you have the E and the S side. The E and the S quadrants is the employee and the self-employed quadrants. That's your active income. And then on the right side, you've got your business owner, big business owner, and investor quadrants. And this is essentially how it breaks down. The right-hand side is, as far as the IRS is concerned, your passive income. And you can learn anything about what a country wants its citizens to do by studying its tax code. So you'll learn some of that in another session. But essentially, the tax code, the US tax code, incentivizes people, its citizens, to become business owners and investors by giving them preferential tax treatment, and disincentivizes employees and self-employed people by having them pay more taxes. And you can argue about what's right and what's wrong, but all I'm saying is this is the reality at the moment. And if you earn a W-2, it's the most expensive way to pay taxes. And I think you know anyone who works a job can see on their pay stub every 2 weeks or every month or whatever it is that Uncle Sam does like to take a big chunk, especially as you earn more and more money. That is not considered active income, or that is not considered passive income. So let me just make sure. Whoop, come back. Check one thing here. Okay. So what we've learned is that the wealthy are either business owners or real estate investors or both. And this is how they became wealthy if they didn't inherit it. I'm not talking about anyone who's gotten inheritance because they didn't do that, but anyone who became self-made or were made with the help of the people who cared about them, their community and their society at large, they were business owners and real estate investors. So these are the 5 pillars of wealth. That's taxes, banking, business, real estate, and education. I want to focus today on banking. As a disclaimer, this is a hypothetical example to show you how this principle works. It's general information. It's not intended to be specific to your case. Personal finance is personal. So however your situation is going to be different from someone else's. But what I'm going to show you here is broadly and generally how we can start to build our own banking system such that the banks, we're going to essentially use the banks against them, the banks' money against them, such that we get to keep more of our own money when it comes to interest. So a typical employee, let's say they make 60 grand a year. That's like the median household salary in the US. A typical American will bring $5,000 in. Let's just say after tax for simplicity's sake. Okay. And the banks teach us to put it into our checking or savings account, CNDS here. Have you ever wondered why they tell us to do that? Or you're just like, oh, that's what you do. Let's just do it. Do what everyone else is doing, right? Well, that's how you stay broke. So the typical worker in America will bring 5,000 in, and if they own a house, they will pay a mortgage on that. And we're using average numbers here across all of America. We got this data from nerdwallet.com. So you can look this up and you can adjust the numbers to fit your own case. I also have a calculator that I can send you for that, an Excel one, and you can plug in your own numbers. But we're going on average here. We got a $200,000 single family house that a family is living in. You got that they have a mortgage on. They have a 30-year mortgage on, and that comes out to be $1,200 a month in principal and interest at a 6% average interest rate. And nowadays that's gotten better and better, especially with, lowering interest rates by the feds and such. But this is just on average. They might also have a car because they got to get from their house to their job. And that's, things are changing as well nowadays where we're actually able to save more as workers on some of these aspects in life. But we probably still have a car because suburbia is quite sprawling, and therefore we need to get around, and there's no public transportation. And also, people like having their cars. So let's say they have a car, they owe $12,000 on it because they bought it for some reason, brand new, or even a used one, which I would recommend is buy your car 3 to 5 year old used one. I actually went even older than that myself, but great fuel economy on a Prius. But they'll owe, again, another 6% amortized loan rate and $600 a month car payment. Then they'll have a $15,000 or $12,000 balance on average on their credit cards with a $15,000 limit. So they're like basically maxed out here with a $600 a month minimum payment across all their cards at a 21% interest on average. Some are less, some are more. I have like 30 of them. of these credit cards, and some are in the 16% range and some are in the 25% range. And then of course their lifestyle. So you got your living situation, your transportation taken care of, your credit card bills and such. Your lifestyle will take into account all of your normal expenses, your bills, your food, groceries, anything like that, leaving the rest in your savings account. And again, you know, you ever wondered why you do that? Yeah, okay, cool. This bank will pay 1% interest. Let's just say, you know, but if you find a bank that pays 1%, and I know of a few, some even pay 2%, but that's still tiny. But most banks actually pay 0.1% or 0.01% or just no interest at all, so it's pointless. So why do we do that? Leaves you with 5,000 out and cash flow of 0. As others have said, it's too much month at the end of your money. Here's an analogy for you. Freezing point of fresh water at sea level. Is this true? Give you a second to think about that. How about now? Is that true? Probably not. Well, actually, definitely not. How about now? You see, the difference is we're missing a unit. So you got 32 degrees Fahrenheit, 0 degrees Celsius. This is a true statement. This is the freezing point of fresh water at sea level on Earth. And before, we didn't have enough information. Which one's hotter? It's 1 degree Celsius. So if you had to explain this to a 5-year-old, you might say something along the lines of, it's a different unit, it's a different measurement, it's a different way, it's a different scale, so they don't go 1 to 1. When it comes to interest rates, which one is more expensive? Immediately, we might say 21% is obviously more expensive. And this is APR, so it's annual percentage rate. That means how much interest is being charged over the course of 12 months. If you kept the balance stagnant and not moving. So this percentage sign, unlike in temperatures, there's no second unit. You know, well, degrees is not a unit, but there's no second unit. There's no unit to add on to the percentage sign. And there's actually quite a difference here. So here's our previous situation. The difference is the stuff on the right side here is amortized loans. And the stuff on the left is lines of credit. Amortized loans, the Latin root of that is mort. Mort, if you took your Latin, it means death. Muerte in Spanish means death. And gage, well, if you look at the root word of a mortgage, like the loan that you use to buy the house, is 30 years. There it is. It shows up as death. And gage means the same as wage, which means a pledge or a promise. So we're using 30-year death promises to buy houses. On the other hand, we have simple interest lines of credit. One big bonus you'll see by the arrows here is that simple interest lines of credits work 2 ways, meaning you put money in, you can take it right back out. So if you ever overpay it, you can spend it the next month. The amortized loans is one way. So if I go to the, if I go send a check to my mortgage company and say, hey, I want to pay my mortgage down faster, here's an extra, principal only payment. And then I realize next month, oh no, an emergency happens. I just spent that money. I no longer have it. And I can't go to the bank and say, hey, can you give me that check back? They won't let you do that. So we're going to get around that a little bit, okay? Here's what an amortization schedule typically looks like when you draw it out. A $1,200 a month average mortgage payment. In the first payment, in the first month of payment, $250 of that $1,200 goes towards the principal, and $950 of that goes to the interest. It's front-loaded interest, meaning the majority of the interest over the course of 30 years, amortized and then front-loaded, means that you're, for the most part, until you hit year 20, you won't break, it won't be 50-50 principal and interest. And then by the end of it, you'll finally get to a point where 950 is principal and then 250 is interest. But most people don't even make it to that far because things like interest rates drop, and there might be some strategic reasons why you want to refinance. Typically, a lot of people refinance around 4 or 5 years, whether 4 to 7 years, whether they move out or they sell the house and move out, or they just simply need to pull that extra cash out. However, they just spent 5 years, the first 5 years, when majority interest only payments, or not interest only, but majority interest payments into their mortgage, and then they go refinance that, essentially restarting the debt clock and making it so they turn their 30-year mortgage into a 40-year mortgage, and so on. So this part is where people lose a lot of money. So if you had made 48 payments of $1,200 a month, you would have already made 45 plus $12,000. That's $57,000 of payments, and yet you've only paid $12,000 of the principal. So how do we pay $12,000 of the principal faster? Let's take a look at this. Perspective, cash flow perspective, okay? So lines of credit, credit cards, personal lines, home equity lines of credit, anything that says line, not loan, there's a difference there. Some banks actually call their lines of credit loans, and it gets even more confusing, but that's an aside. So in the loans, you pay principal and interest, and you lose all your cash flow because you can't pull it back out. On the lines of credit, your principal is liquid, meaning as you pay it, you can always pull it back out if needed. Okay, so rule number 1, lines are better than loans. And rule number 2 is that the employee mindset, cash is currency. They spend what they make. And a wealthy mindset, cash is velocity, makes you go faster. There's a concept called the velocity of money that you can look into. There's also another concept called time value of money that you can look into. The leverage is currency. That's where the time value of money comes in. Money today is worth more than money tomorrow due to inflation. That's natural. It's by design. It's by the central banking design. So hypothetically, what if we did something like this? We take our $5,000 in and applied the entire thing to the credit card balance that in this case had $12,000 in balance on it. And let's say you didn't have $12,000 in credit card balances. Great, that just means you're ahead of the game and we can go faster. So we can skip a couple slides. But for a lot of people, they're broke because they got $12,000 or more in credit card balances. So what if you took that entire income and just dumped the whole thing in a credit card? We'd be like, well, I don't have any more money. Well, that's not true, because you can just go use that credit card again. And if you don't know how to use credit cards to pay your bills, your mortgage, your car loans, whatever it is, put it in the chat or message me or contact support, and we can go over that. So when we do that, we've wiped out our $600 credit card payment, and we have a ton of additional limits available on our cards now. We'll also get rid of our savings because 1% interest is pointless. The bank. So here's an idea. Why not put money into savings? Well, you put money into savings that the bank. Let's say the bank pays you 1%, and then they go take your money and they go loan it out to someone else at 6% interest for this car loan or this mortgage or whatever it is. So they're going to use your money to lend to someone else, and they're essentially doing what's called arbitrage. But how much money is the bank making when they do that? Some people might incorrectly say 5%, but 5% would be borrowing at borrowing $1 and paying $1.05. That's 5% in a year. But no, if I buy a pen for $1 and go sell it to someone for $6, I've 5x'd my money. That's 500%. Okay. And then you have this concept called fractionalized reserve lending, where they can take that 500% they made and go loan it out to. They take your same dollar and loan it out to 7 different people, making 3,500%. So the banks make the most money off of your money, and it's no wonder they have the biggest banks. They have the biggest buildings in every city in America. So we're gonna not do that. If you ask what's in my savings, it's like 1,000 or 2,000, barely, just enough to make sure my auto payments come through. Okay, so when we make that principal only payment, well, it's not principal only, but what is principal only payment? Straight at the line of credit, we immediately lower our balance from 12,000 down to 7,000. That's 5,000 in. But that's the beginning of the month. Let's say, oh yeah, of course, we got, how are we gonna pay the bills? We're gonna use a credit card to pay the bills. We got $3,000 of expenses, right? That includes the mortgage. So expenses go out, but you'll see that savings that would have been sitting in the savings account while you have debt is silly. And it's better to put that savings to work, saving you 21% interest. Well, over a month, so you take that divided by 12. So you save that amount of interest because that money, the interest on a line of credit is calculated as an average daily balance. So they take the interest rate over a year and they divide it by 360 or 365, and that's your daily interest rate. And they multiply it by the amount that you have in balances on that day, and they charge that interest. But they don't actually charge the interest until the end of the month, and only if you don't pay the statement balance by the due date. So you can essentially like borrow the money for like 30 days to 55 days at a time without ever paying interest. So there's that. But even if you did pay interest, it's still going to be cheaper because we're going to keep moving the money, keep depositing money, keep taking expenses out. A couple months down the road, if an emergency happens, well, you got lines of credit to go use in case such an emergency happens. Remember what your parents always said was only use this for emergencies. Well, yeah, we're going to only use this for emergencies. We're also going to put all of our money into it and then take all of our expenses out of it. But an emergency is an expense that you did not predict. But if there's no emergencies, we'll pay it down in 6 months. $12,000 gone. And where did that money come from? Is only because we had an additional cash flow of $2,000 every month that brought that money down. And that cash flow came from saving from the minimum payments and also saving it from savings. And that was leveraged to really expedite the payment of this balance. And that's why it's called velocity banking. And guess what? When you pay off your credit card, you get a credit limit increase. So now, we've gone an extra $10,000. Now a new limit is $25,000. Now we got a big chunk of money, bank's money, to spend to do whatever we need to. So let's use that, or not. It's there for emergencies, and it's there to use it to only buy assets. Okay, assets are, from the financial definition of assets, are things that make money for you, things that cash flow. That means if it's costing you money on a monthly or yearly basis, it's not an asset. Your home, not an asset, costs you money. If you rent out your home on, say, short-term rentals, Airbnb, VRBO, things like that, okay, now it's starting to make money for you. One would argue as well that if you're saving money on rent, then it's like making money. However, you just got to run the math, do the numbers, such that you actually are saving. Because remember, the interest, a good chunk of the interest of the amortization schedule is essentially lost money. Okay, so we've gotten rid of our credit card, we've gotten rid of our savings, and we've gotten rid of our balance on our credit card. We're going to take a principal-only payment of $12,000. Remember, it took us 4 years and $57,000 initially to pay off $12,000 in principal from a car, or from our home. So we take, instead, what if we just said, hey, I'm going to take this $12,000 check that I got from my credit card. There's ways to do that. And just use that to pay my mortgage. Okay, bam, 12 grand off. And immediately you've jump-started the amortization schedule to where you were, essentially bought yourself 4 years back and $45,000 in interest saved right there, just like that in one move. Okay, but Earl, you have to pay interest on your credit card too, right? Well, yeah, there's ways around that too. I've mentioned, you know, that if you keep the money moving over 30 to 55 days, you never pay interest, but you also can get 0% APR credit card, 0% APR credit cards. But also, as long as you keep the money moving, it doesn't matter that the credit card has a 21% or 25% or 30% interest rate, because the money never stays there. The balance never stays there for too long. We're constantly funneling all of our income against it. And all of the days in between, from when you put the money in to when you take it out for expenses, that is savings, because the average daily balance becomes lower than it would be if the money was stagnant. Okay, keep the money moving. Now, oh, I just kind of went over this. What about the interest? Well, let's say you couldn't find a 0% APR credit card, or you just didn't have the credit for it. And they really don't take much. Even if you've got 600, 650 FICO, you can get a 0% APR credit card. But of course, there's ways to boost your score a little bit if you know the rules and play the game, such that you can get the best of the best and also get travel miles. There's all these ways. I'll show you in a second half of this. But let's just say you pay 21%. You got $12,000 balance. If you left that there for an entire 6 months without paying, if you just like took that balance and left it there and then banked the money instead of putting it right into the every month, instead of putting it right into the line of credit, let's just say you banked it for some reason. That means it's $12,000 sitting stagnant for 6 months in a credit card and then getting wiped out at the end of the month, at the end of the 6 months. Well, that means you would have paid, divided by 2, 6 months out of 12, you paid $1,260 for that $12,000 balance in a course of 6 months because you left it stagnant. And it's going to be less because, so this is the upper bound. It's going to be less because we're keeping the money moving and our average daily balance is constantly decreasing. Contrast that to $45,000 in interest that we would have paid if we just made our mortgage payments for the first 4 years of its term. Okay, so $12,000, pay that off, repeat and repeat and repeat until the entire loan is paid off. And this is how you'll pay your mortgage, your 30-year mortgage, in a matter of 5 years or less, depending on your balance and depending on your cash flow and all that. So now we've gotten rid of our mortgage. There, you got a house paid off free and clear. Yay, fantastic. We're going to really start to leverage that. We're also increase our cash flow because of that. We no longer have a mortgage payment. We now have much more money coming in that's not going out. Let's knock off the car, do the same thing. Bam, it's gone. So now you're debt free. And as you wipe more and more monthly payments out, you reduce your bills. You reduce your monthly bills by doing this, and you pay off all your debts faster. So yay, we're debt free. Congratulations. However, you're supposed to pay off your debts. It's not, well, I mean, yeah, it's good to congratulate, but also this is literally what you're supposed to do. You know, you go out and work, sign a contract with a lender or bank or whatever, with a promise to pay it back. So here you are, you paid it back. Congratulations. And you try to lose as little money in interest as possible along the way. Let's take it to the next level. Okay. Okay. Hypothetical scenario. We're going to start to get into real estate investing a little bit as a basic concept. No specific strategies at the moment, but let's just say they're rentals for now. Okay. Hypothetically, we owned a house free and clear. There's a product that the banks and lenders have that is called the home equity line of credit, or HELOC. If it's not a home, if it's a rental property, they have like other kinds of equity lines of credit, like business lines of credit and all that, BLOCs. Anyway, line of credit on your personal home. Let's say we took $200,000 out of that home. There are HELOCs that go all the way up 90 to 100%. Well, 100% is a little harder, but let's just say it appreciated and you had a little bit of equity and you're able to pull out $200,000 off that. We're going to buy 10 houses at $20,000 each in terms of down payment, and they're all rental properties. That means you only buy properties that cash flow. Okay, cash flow. They must cash flow. If they don't cash flow, it's not an investment. It's not an asset. It's a liability. We're gonna buy $20,000 houses, or we're gonna put $20,000 down each on each of these houses, using the house so that houses buy more houses here. And cash flow, our assets pay off our lifestyle and expenses and all that. Congratulations, you have officially become financially independent. This is what some people would say lean fire, or fat fire, depending on where you are in life. But essentially, if your total monthly or total passive income is greater than your monthly expenses, you have reached financial independence. And we have no debt. Now, a lot of people are actually in debt $1 million before they make $1 million, or their net worth is $1 million. So it's okay. Like, I'm telling you, go get more debt. But debt can be a good thing if you know how to use it properly. It's just a tool. Okay, so you've got this $30,000 line of credit. You put $20,000 on your personal loan, your mortgage on that. You pay off your car and put it all on a line of credit. And you got a balance of $25,000. You pay that down in a matter of 10 months or a year or anything less than that, depending on your income. So we do the same thing I just showed you. Then you wipe it off, and finally, this friend of mine was able to take that $30,000 on a credit card and put $20,000 on a down payment on a duplex. This is actually something I also did myself, but I did it well before I knew of this strategy, so I accidentally stumbled into it myself. I took $15,000 from a personal credit card that I had. I had an $18,000 limit, so not quite 30, which means my utilization skyrocketed, and it caused my score to go down quite a bit. However, it didn't go down enough that I wasn't able to buy a rental property. So I took that 15 grand and a little bit of savings that I had. And had I known then what I knew now, I would not have locked up so much of my savings into this property. However, that's what I did. I used a little bit of card, a little bit of credit card, a little bit of cash, and bought a 3-unit rental property on my own. Oh, yeah, with the bank's help too. Okay, so some people are feeling like this and other people are feeling like this, right? You might be confused, frustrated, broke, confused. I already said that. But as long as you're open to allowing these ideas to flow into your mind, anything is possible. So for now, okay, at this point, did anyone have any questions about what we just went over? Because that was definitely a lot. It took me a while to wrap my head around that. Wow. I took a lot more, I read a lot more books on it, and took a lot more classes, or took a few more classes on that, and studied that or practiced it to actually implement. So it's not something I expect to really if you get it, you get it. If you don't, let it season. Okay, so we're going to shift gears a little bit, not exactly, not completely, but we're going to think about how we're going to start our business. And then, as I mentioned, the wealthy are business owners or real estate investors, and they operate everything that they do as a business. They might also have a job, and that job may or may not, maybe in someone else's business, or it might be in their own business. But if you're just starting one, the key is a good way to start one is to have a mission and vision. What is your why? Start with why. Okay, that's Simon Sinek. He's got a TED Talk out there, a couple books, bestsellers. So start with why, and then the how, and then finally the what. It's a concentric circle in which your purpose is what should drive you in life, not money or anything. There should be a deeper purpose, and you can go through this exercise where you ask yourself why and why and why about 7 layers deep, and you ultimately get down to the bottom of why you do what you're doing. You set big goals, set 30-year, 60-year, 90-year goals. Some goals of mine are goals I'll never achieve in my lifetime. Walt Disney never saw Disneyland in his lifetime, but it was a goal that he had set and he had passed before it was fulfilled. But he got started on it, so that's important. It's generational. We're going to create a vision board. A vision board is simply a 3x3 grid of images and words that spark you and motivate you to continue and push on and have that grit. It's going to be in the topics, the categories of 3 each for health, wealth, and relationships. So health, relationships, and wealth, 3 each, pictures, cut it out of magazines, print it out from the printer, whatever. Put it on a poster and stick it on your wall and make sure it's something that you see every day. Make a clear strategy. So strategy is essentially, the game plan, right? This is like, the plot, the outline of it doesn't have to be necessarily step by step, but it is the bigger picture. Take action. That you need a daily and monthly action plan. So you're always continuously, bit by bit, getting at that goals and chunking away at it. You're gonna feel good and manifest fast because the universe gives us what we think about, we bring about. So as you celebrate your wins, you can reflect on those, and that drives you to push on and become, accelerate your journey. Where do we find the money? How many times we have? A few minutes left. We're gonna breeze through a little bit of this. These are ways to raise capital without necessarily using your own. So you got cash. Okay, you got a little bit of cash. I had to use some of that myself from savings account or retirement accounts or whatever. But you also have personal credit. So you got the credit cards. We showed you that whole strategy. So you acquire those. I've got, like I said, I've got like 2 dozen of those credit cards, maybe more. I'm not sure now. I've got a spreadsheet of them. And, I use those strategically. I'll show you why as well. Been playing this game for over 5 years. You got retirement accounts that are not just your own, but others. We have home equity line of credit, kind of showed you that. We can use that to buy, a bunch of houses, buy more houses. Private funding is your friend, your triple F, your FFF round, your friends, family, and fools. Somewhat in jest. However, people who trust you enough to invest in you and your business could get a higher reward as well on their end. So you don't ask for money, you make an offer. Okay, what can I offer you to make this return better than what you're currently getting on that money? We also have life insurance. So you got permanent life policies, whole life, things that are not term life. There's such a thing as cash value on those that you can use to borrow against to do investments in. Funding assessment is you get this. There's this third-party company that I know of, and then that they work with like 100+ different banks, and they help you find the money in order to they'll help you essentially. They know which banks pull from which reports in what order, and so they'll apply it they'll apply for each of those cards for you strategically, or personal lines of credit, such that you get the maximum amount of available funding available to that you can get. And since part of the credit score game is the debt utilization, you want to maximize that so you can use a little bit of it, less than 30%. You got business credit, which is a whole nother topic. I'm not going to go into that. 3 ways to leverage retirement accounts. You can borrow from them. So this is not just your account. This could be someone else's account. You can borrow from it, you can withdraw from it, and you can, or you can roll over and self-direct it. So did you know that you can use a retirement account to invest in real estate or cryptocurrencies or Super Bowl tickets or literally whatever you want? Anything that's considered an investment, which means it has the, it has the potential for higher return in the future, means that you can use your retirement account or someone else's retirement account funds to purchase that investment. We can also borrow against it. There might be some interest rates. These are the rules, essentially. This is just a brief summary, but the CARES Act signed in April of 2020, temporarily through the end of the year, increased the limit to 100% or $100,000, whichever one is greater, or whichever one is less, I mean. So up to $100,000 that you can pull out with no payments for 1 year as well. There are some stipulations, but generally, everyone's been impacted by COVID, so there's that. It is also tax-free if paid back within 5 years. If you would decide to withdraw it anyway, normally it's like, oh, you can't touch that money. You're gonna have to pay penalties and taxes and all that. No, that's a myth. You can always it's your money. You can always tap into it. If you don't want to pay the 10% penalty, well, sometimes you do. Where this investment I know is going to make me 20, 30, 40, 50%, especially get into real estate, it's like, wow, triple digit returns, not unheard of. So sometimes it's worth paying that penalty, but right now you don't have to. So that's good too. If you're 55 years old or turning 55 and you leave your employer, you can actually also pull that out with no penalty. And there's, of course, then you got the rollovering and not of course, the way you use the retirement account directly without pulling it out or borrowing from it. It is the retirement account doing the investing is called a self-directed retirement account. So you can do that with your own or other people's. But here are the questions I generally ask. I just asked the first one right now. Did you know you can use a retirement account to invest in real estate? And then this is a probing questions that you can start a conversation. The way I see it is that you are only one conversation away from making $1 million. So, start a conversation. If you don't mind me asking, how much do you have in your retirement account? If you don't have your own, do you know someone who does? What kind of returns are you currently getting? And if I could show you how to get double-digit returns, or you could say, if I could show you how to get double or triple your current returns on your investment, purchasing assets secured and insured by real estate, would you be open to having a conversation about investing with me? And this has to be a second. There's regulations about raising capital that the SEC, want to be careful of. But yeah, so you roll over the funds into a self-directed retirement account, and then you show them how to do this, and they can do it themselves too. Now that you know how to use your own or someone else's retirement account to invest in real estate, how much of that capital are you open to redeploying? And some people will say, put all of it. No, there's other people will say, okay, let's take a small chunk of that and let's see what you got. See how we can do it together and generate a higher returns on that and leave the rest in the stock market. However, some people don't want to be involved in the stock market anymore. They want something better, an asset that they can control. Okay, so we spoke about the HELOCs as well. Home equity line of credit. There's not really too much about it, but it's basically a big credit card tied to your house. And if you don't pay the credit card or line of credit back, they'll come take your house. So careful there. But that's the case for mortgage too. So as long as you're good and responsible, you have the ability to respond, you're responsible, then you can leverage these tools. These are just tools. I mentioned friends, family, and fools. It can be a gift or a loan. You can actually use gift funds to buy real estate directly. Like they don't need the bank doesn't need to see the down payment in your bank account. It can be in someone else's bank account, and they'll gift that to you, or your partner. Your investment partner will gift that to you in order for you to buy a house that is a 2 to 4 family, for example, on an FHA loan as 3.5% down minimum. And you can buy a house that you also rent out. Maybe you buy a single family and or apartment, or you buy a condo and you rent out all the bedrooms. You make another bedroom in the living room. Some people have done that. I know I've slept in the living room for a year. And depending on how much sacrifice you want to do, that you can adjust that, or you can buy a 4 family using the same FHA loan, 3.5% down, potentially using gift funds as well, and leverage that, and you make you make a good return on your $0 investment or whatever it is. So you got infinite ROI, and then your capital partners make a higher return on their investment as well. Make sure everything's in writing. You don't want to ruin relationships over this. Okay. And then you got life insurance policies I mentioned as well. It works just like the velocity banking. There's this concept that a lot of financial advisors, AKA life insurance salespeople will show you that is called infinite banking, and it works basically like velocity banking. However, instead of using the bank's money, you're using your own money. So like, this is something for a little bit later on, or something if you or someone else had set up for you, or for themselves even. Okay, grandma, how much money you have in your life insurance policy? Well, what do you mean? Well, if you have a whole life policy or permanent life policy, or universal life policy, whatever they call them nowadays, different products actually, there might be cash value on that. How much return are you getting on that? Can I tap into it? Same question as you would in a real retirement account. And you pull that money out, and well, they loan it to you. There might be, you might write a promissory note, so everything's in writing. And instead of getting 5% on their whole life, maybe you give them 10%, 15%, whatever it takes to sweeten the deal, and you have cash, and you go buy yourself real estate. Okay. There's this company, getfundedonline.com. They're third party. I don't get paid by them, but I've used them in the past, and they're really solid and very ethical people. And they partner with like 100 plus, 110 plus different banks. They know exactly which banks you'll get based on your credit profile and the data from your reports. They know exactly which banks will approve you and for which products, and they'll maximize the amounts that you can get. You can also speak to a local banker or a local college representative. Usually there's a little office in a lot of the community colleges, state colleges, public colleges, or even private ones. They'll have a small business administration department, sort of, or someone, a liaison, to help you, guide you through applying for a small business administration, SBA loan. There's different kinds of SBA loans. And a lot of them are tailored specifically for people starting their own small business. And you got personal private loans as well. You can always, go to creditkarma.com or NerdWallet or whatever. There are all these ways you can find, if you decide to go not to go through some other, kind of do it on your own. You can apply for loans anywhere, personal loans in the 5 to 15% interest, 18%. I don't know. At some point it starts to, depending on what you're using that money for, it start to make sense. And now you have the tools on how to pay that down really quickly. So it doesn't matter that it's 18%, because we're going to chunk away at it really quickly, and it'll be knocked down to zero, not in 5 or 10 years, but in 1 or 2. Okay. So yeah, so if you ever played chess, I played chess a lot. You got to choose your next move. You learn that W-2 is the most expensive way to pay taxes. Mortgages are the most expensive loans on existence. They're the most expensive way to pay interest. Checkings and savings accounts were pushed on us because they benefit the banks. They don't explain why. Here's why. I showed you. This is the velocity banking strategy is how they do it in Australia, actually. They don't even do 30-year mortgages there. They do. This idea came from there. They do 10-year line of credit, like a HELOC, and then anything, you have 10 years to pay it off really quickly. And if you don't pay it off, they take the balance and amortize it over 20 years, and then you'll pay like a traditional mortgage. But they skip that whole first 10 years there. Because the banks there are not as greedy, I guess. I don't know. And jobs are the least effective way to make money because, it's like, oh, I have a, what do you call it? Fixed income. But if you think about it, a salary is a fixed income. While if you own your own business and invest in assets like real estate, stock markets are also another thing. Cryptocurrencies, that are also things that I dabble in as well. But real estate is really where it's secured and insured. That's the only asset type where a bank or lender is going to give you 4 times the money that you put in. So 80%, or so it's like a 5-to-1 leverage or 4-to-1 leverage, whatever it could be. You put in 3.5% on an FHA loan, and they put up 96.5%. Because they know that if you mess up, they'll just take the house. Now, the banks don't want to be landlords, or they don't want to be property owners. That's what, they want to get rid of their real estate owned, the REO properties at auction or foreclosure. But, or even a forced sale, but they don't want to own properties. They just want mortgages. That's how they make money. On the bank's balance sheet, the mortgage is considered an asset, which means their asset is someone else's liability. That's your liability. And so yeah, that's all I've got for today. We've got more. Our next session will be at this time, 3:30 p.m. Mountain Daylight Time next week on Sunday. And if you have any questions, please contact support@guru.com to schedule a one-on-one lesson, or otherwise just ask a question. You can type it in here in the chat. If I'll stick around for a little bit, and mention my name, Earl, once again, and they'll get you in contact with me. Okay. All right. So thanks for your attention.